Welcome back, students and scholars. In this episode, we begin Accounting Standards Codification Topic 250 on accounting changes and error corrections. This topic is not about memorizing one formula, it is about diagnosis. Something changed or something was discovered, and the accountant must decide what kind of event it is before choosing the accounting treatment. Think of ASC 250 like a traffic controller at a busy reporting intersection. One road is accounting changes, another road is error corrections, and if we send the event into the wrong lane, the financial statements can quickly become confusing. So, today, our first goal is simple: classify first, treat second. Why does this topic matter so much? Because users compare financial statements across periods. Investors, creditors, analysts, auditors, and management all look at trends, ratios, margins, and movements. If a company changes an accounting principle, revises an estimate, changes the reporting entity, or finds a prior period error, the current numbers may no longer be directly comparable with the past. Without clear treatment and disclosure, users may think performance improved or declined when really the accounting basis changed. ASC 250 protects comparability. In plain English, it helps users understand whether the story changed because the business changed, because accounting judgment changed, or because the past numbers were wrong. Before we choose the treatment, we ask the core question: what exactly changed? This is where many mistakes begin. Students sometimes jump directly to retrospective or prospective without diagnosing the event. In practice, that is like prescribing medicine before knowing the illness. Did the company switch from one acceptable, generally accepted accounting principles method to another? Did new information revise a forward looking estimate? Did the reporting boundary change, such as moving from separate statements to consolidated statements? Or did the company discover that earlier facts were misused or ignored? That diagnosis controls everything that follows. ASC 250 gives us four possible lanes. The first lane is a change in accounting principle where one acceptable method is replaced by another acceptable method, usually with a preferability justification. The second lane is a change in estimate where new information updates a measurement such as useful life, bad debt rate, or warranty percentage. The third lane is a change in reporting entity where the financial statements now represent a different boundary of entities. The fourth lane is error correction where prior period statements were wrong. Same standard, four lanes, four different consequences. The lane is not decoration. The lane decides the treatment. Now let us separate accounting change from error correction. This distinction is essential. An accounting change is a permitted update. The prior financial statements were not necessarily wrong. For example, a company may adopt a preferable acceptable method, revise a reasonable estimate after new information, or change the reporting entity presentation. Error correction is different. It means the prior period financial statements contained a mistake. Maybe data was available but ignored. Maybe a formula was wrong. Maybe GAAP was misapplied. That is why we should not casually call every change a correction. If the past was valid, it is a change. If the past was wrong, it may be an error. A change in accounting principle means one acceptable GAAP method replaces another acceptable GAAP method. This is not about correcting an unacceptable method. If the old method was wrong under GAAP, that is an error correction, not a voluntary principle change. For a principle change, the company must normally show that the new method is preferable because it improves financial reporting. A simple example is inventory costing. Suppose Atlas Retail changes from FIFO to weighted average because its upgraded warehouse system now blends inventory flows across locations. If both methods are acceptable and weighted average better reflects the actual flow, this may be a principal change. The usual treatment is retrospective application. A change in estimate is different because estimates are forward looking. Management makes reasonable estimates using the best information available at the time, but real business conditions change. A machine may last longer than expected. Customers may default more often than expected. Warranty claims may rise after new product data appears. When new information changes a reasonable estimate, we do not rewrite history. We update the accounting from the current period forward. That is why estimate changes are normally prospective. The old estimate may have been perfectly reasonable when made. The accounting simply improves as better evidence becomes available. In accounting, being wrong because the future changed is not the same as being wrong because the past was mishandled. A change in reporting entity is about the boundary of the financial statements. It is not merely a new transaction, and it is not merely buying or selling something. The question is whose results are being presented. For example, a parent company may previously have presented only its own standalone financial statements, but now presents consolidated financial statements including subsidiaries. Users need comparable information, so prior periods are normally recast to reflect the new reporting entity. The objective is like for like comparison. If this year shows the group and last year shows only the parent, the trend would be misleading unless prior periods are adjusted to the same reporting boundary. Error correction is the most sensitive lane because it means the prior financial statements contain a mistake. An error may come from a math mistake, wrong application of GAAP, misuse of available facts, or even intentional misstatement. The key test is whether the information existed when the prior statements were prepared. For example, if River Manufacturing used the wrong depreciation formula, even though cost, salvage value, and useful life data were already in the records, that points to an error. This is not a new estimate, it is a prior period reporting failure. If the error is material, the affected prior period statements may need restatement with clear disclosure to users. Once classification is confirmed, the treatment map becomes much easier. Principal changes usually use retrospective application, meaning prior periods are recast as if the new principle had always been used. Estimate changes use prospective treatment, meaning the current and future periods are affected, but prior periods are not reopened. Reporting entity changes are generally applied retrospectively, so all presented periods show the same reporting boundary. Error corrections use restatement when the prior period error is material. This is the heart of ASC 250. Principal and entity changes look backward for comparability. Estimates look forward because they use new information, and errors correct the past when the past was wrong. Let us be very careful with the word restatement. Under ASC 250, restatement is not a casual word for we changed a number. It is generally reserved for correcting material errors in prior period financial statements. That word carries weight. It tells users, auditors, regulators, and the market that previously issued numbers were incorrect. Do not use restatement for a normal estimate change. Do not use it casually for a principal change either, that is, retrospective application. Precise language matters here. In exams and professional memos, using the wrong word can reveal that the classification itself is wrong. Accounting language is not fancy decoration, it is risk control. Now, let us run a fast diagnosis drill. Take a moment with each scenario and classify the lane. If a company switches inventory costing from FIFO to weighted average because the new method better reflects actual flow, that is a principal change. If bad debt percentage increases because actual collection data worsened, that is an estimate change. If a parent begins presenting consolidated statements including subsidiaries, that is a reporting entity change. If depreciation was calculated using the wrong formula, even though correct data was available, that is an error correction. Notice the pattern: acceptable method switch, new information, boundary shift, or past mistake. That is the diagnostic rhythm. Here is the memory map for the whole topic. First, name the change. Second, apply the treatment. Principal change, retrospective application. Estimate change, prospective treatment. Reporting entity change, retrospective application. Error correction, restatement if the error is material. This map is powerful because ASC 250 questions often look complicated only because the facts are mixed together. Once you identify the lane, the answer becomes much cleaner. So when you see an ASC 250 question, do not panic. Slow down, identify the event type, and let the treatment follow the classification. The accountant who classifies well usually answers well. That completes our big picture introduction to ASC 250. In the next episode, we go deeper into accounting principle changes and reporting entity changes, especially preferability, retrospective application, impracticability, and entity boundary issues. If this video helped you, please like it, subscribe to the channel, support the channel, and share it with your colleagues who are studying or working with financial reporting. Your support helps this channel reach more serious accounting learners. Keep this simple rule with you: classify first, treatment second. I will see you in the next lesson where we move from the map into the mechanics.